following content is provided under a Creative Commons license. Your support will help MIT OpenCourseware continue to offer high-quality educational resources for free. To make a donation or view additional materials from hundreds of MIT courses, visit MIT OpenCourseware at ocw.mit.edu.
So today we're going to continue our discussion of capital markets. Remember the introduction from last time? What we talked about was the fact that we talked about labor as an input and where it came from. And these lectures are about capital as an input, where it comes from. We talked about the fact that while capital ultimately is machines and buildings and things like that, when we think about it in this course, we're going to think about financial capital and basically what's behind all the different kinds of capital that businesses use. We talked about people's savings decisions as creating a pool of capital from which businesses draw. And then we talked about present value and the notion of considering the fact that dollars in the future are worth less than dollars today. So with that as background, what we want to do now is talk about how firms and individuals should make choices over time. We talked a couple lectures ago about how firms and individuals make choices when faced with uncertainty. So that was sort of a choice across two different states of the world. You could get hit by a car, you could not get hit by a car. Now we'll talk about choice across two different time periods, today versus tomorrow, and how people make those choices. Okay? And the answer is going to be pretty simple following what we did last time, which is whenever you're faced with two choices that pay off at different times, you just want to choose the choice with the highest present value. Okay? So if your choice faced with two streams of payments, you know that you can't just add them up. What you need to do is you need to add them up in a way that gets present value. So for example, consider the example of a professional athlete who's considering two contracts. One contract pays $1 million today, and one contract pays $500,000 today and $2 million in deferred payments in 10 years. Okay, so that's the two contract options facing the player. Okay, so if you read it in the newspaper, okay, they would describe this as a $2.5 million contract and it's a $1 million contract. Okay, however, the newspaper's wrong because they haven't accounted for the fact that some of those payments are deferred, so they're worth less. Okay, so how do we compare them? Well, to compare them, we have to take the present value of these two streams. So the present value of the first stream is just $1 million because it's paid today. So putting in today's dollars, it's worth $1 million. The second stream is worth, the present value is $500,000 plus $2 million over 1 plus I to the 10th. Okay, because it's being paid in 10 years. And actually here, I'm going to not use I, I'm going to use R for the real interest rate. Remember last time we ended and talked about how what really matters is the real interest rate. The interest rate you get minus inflation, minus the cost price increase for goods you have to buy with that interest. So remember, it's going to use the real interest rate here, so I'll use R now. Okay? So basically, whether this second contract is a better deal or not depends on what the real interest rate is. Okay? So if R equals 5%, then the present value of this second contract is $1.73 million. So that is a good deal. On the other hand, if R equaled 20%, if there's 20% interest rate, as there was back in the late 70s, early 80s, then the present value is $0.82 million. So it's not a good deal. Okay? So the key is if you want to ever compare two streams of payments that pay off in different times, you have to bring them back to a comparable unit, to today's dollars. And the way we do that is by calculating their present value. Okay? And that's why, and this is a problem people have, a common mistake that's made, is people don't consider this in evaluating streams of payments. So a classic example is when you hear someone wins $100 million in the lottery, it's actually a lot less than that. Because a $100 million lottery win, what it really is it's $5 million a year for 20 years. Okay? And you have a choice. You typically have a choice. If you can take it, you can take a lump sum now, or you can take the $5 million a year over 20 years. So basically, the $5 million a year over 20 years is, of course, worth a lot less than $100 million. What's it worth? It's worth, well, it's worth 5 million plus 5 million over 1 plus the interest rate, real interest rate, plus 5 million over 1 plus the real interest rate squared, plus plus 5 million over 1 plus the real interest rate to the 20th. OK? So for example, for an interest rate of 5%, if R equals 5%, this lottery is really worth $65 million. Now, that's still pretty good, but it's a lot less than 100 million. So when we are faced with when you hear a number about a player's contract or a lottery winning, you need to always recognize that the effective value is going to be lower than what you hear in the news because of the time payment that it takes place. Now, whether that's a big deal or not depends on the interest rate. Okay, so Victor Martinez just signed with the Detroit Tigers for 4 years and $50 million. Okay, that is he could have signed with the Chicago White Sox for 3 years and $42 million, or the Boston Red Sox were offering, they were offering $440. So Chicago White Sox for $3 million and $42 million. Now you might say you can't really compare those two because one's out 3 years and one's out 4 years, but the truth is the interest rate right now is so low you can pretty much compare them. Right now, the interest rate you can get in a bank is close to 0. So basically, if the interest rate's 0, then present value is the nominal value. So right now, you can sort of compare players' contracts like that. Okay? On the other hand, when the interest rate is higher, you can't do that comparison. And in particular, what you'll hear, a lot of times these contracts have very deferred payments. So even for a low interest rate, it's still worth a lot less in the end. Okay? So that's the key point to remember when you hear values, is to know that you have to discount them by when they happen. And that's going to depend on how high the interest rate is. Now this leads us directly to the important implication of present value, which is how firms and individuals make investment decisions. So we've talked about firms choosing a level of capital and a level of labor. And we talked about it in a simple isoquant, isocost framework. But in reality, firms don't really deal with that simple framework. In reality, for any given investment decision, they essentially want to compare the cost of that investment to the benefits of that investment. Okay? And that depends on things like the isoquants and the isocosts, but also depends critically on the time frame over which that investment will pay out. Okay? And what firms consider when they make an investment decision is the net present value of that decision. On net, what's the present value? The net being, because often for the investment decisions, you have to lay out money up front to recoup that money later on. Okay? So this adds an extra dimension, which is not just you're adding up a stream of future payments. You're actually contrasting a debit now versus credits in the future. Okay? And the math is the same, but it's a little bit more complicated. So the net present value of any investment, okay, is going to be the revenues from that investment in period 0 minus the cost of that investment in period 0 plus the revenues from that investment in period 1 minus the cost of that investment in period 1 over 1 plus r, okay, plus plus the revenues in year t minus the costs in year t over 1 plus r to the t. Okay? So the net present value is going to be a function of every year, is the investment making or losing money? And then adding those future gains or losses up, discounting by when they occur. And the bottom line is, firm investment decisions are very simple. If this is greater than 0, then it's a good investment. If it's less than 0, it's not. Okay? And this matters a lot because you'll often see investments that have cash losses up front and gains later on. In fact, that's sort of the definition of investment, right? Is that you're investing some money up front to yield returns later on. So for example, if you have an investment with an upfront cost of $100 in year 1, it's going to cost you $100 in year 1 to buy some machine, and you get no revenues. So year 1, so it's minus $100 in year 1. But in year 2, you're going to earn $200 from that machine. Okay? Minus, you're going to have a $50 maintenance on the machine. So $150 in year 2. So in year 1, you buy the machine for $100. In year 2, the machine produces some widgets, which you can sell for $200, but along the way you have to maintain that machine, and that costs you $50 in year 2. Then on net, the net present value is minus 100 plus 150 over 1 plus r. Okay? That's the net present value. Whether that's positive or not is going to depend critically on what the interest rate is. Okay? So the key thing is we want to take that stream of payments, positive or negative, and put them in today's terms. But this raises, are there questions about that? But this raises the question of, well, what interest rate should a firm use? So the firm's got to make this decision. Should all firms just walk by Bay Bank or Fleet Bank, where the hell it's called now? What's it called? What's the bank, the big bank called? Fleet, I guess. Should they walk by now and still look in the window and say the interest rate is 1% or 2% and 3% and use that? What should firms do? And basically the key issue is that different firms will have different interest rates that they want to use. Or firms will have different, what we call discount rates. That you can have a firm-specific discount rate. You can have a firm-specific discount rate that firms might want to use. And what's going to determine that is going to be the opportunity cost of money to the firm. The opportunity cost of money to the firm. What is the firm's next best use of that money they're investing? Okay? So for example, let's say a firm has a bunch of cash sitting around. Okay? And it's deciding, let's say the firm has $100 in cash sitting around. And it's trying to decide whether or not to make this investment. How do we decide on what the opportunity cost of that investment is, what the right discount rate is to use? How should the firm think about that? If it's got the cash sitting around, how should the firm think about whether it should invest 100? Yeah?
Well, whether or not it has some other place that it can invest it, or it's just going to rot in the safe somewhere.
Well, I mean, at a minimum, it can put it in the bank. Right? So at a minimum, it can always earn 1% or 2% of what our banks are paying now. Okay? But what you're saying is right, is it may also have other investment opportunities. So in some sense, the discount rate for any investment opportunity is what you could earn on the next best investment opportunity. So if I've got $100 sitting around and I've got a guaranteed 10% I can make somewhere, then if I decide whether or not I should take this investment, I should use a discount rate of 10%. If I can make 20% somewhere, I should use 20%. So in some sense, what you want to do is you want to stack up your investment opportunities from worst to best in terms of rate of return. And then you start at the top of the list. Start at the top of the list and ask, OK, discounting at the best alternative opportunity, is this one worth it, given the stream of payments? And then work your way down the list. So basically, the key thing is for any firm, their opportunity cost, their discount rate, is the next best thing they could have done with the money. Similarly, if a firm doesn't have the money and is deciding whether or not to borrow the money to do this investment, then the discount rate will be the cost of borrowing the money. If the firm now, right now, the bank only pays you 1% in your money, but if you want a loan, you still have to pay 4% for it. So it may be that you could have a situation where your $100 doesn't really do you that much good saved, okay? And it would cost so much to borrow the $100 that it's better to use the $100 that's sitting around. So basically, let's say you have $100 sitting around and you're trying to decide how to finance this investment. Well, let's say you have an alternative investment that yields 10%. What you do is you put the $100 in the alternative, and then you'd say, well, should I then borrow to finance this investment? Okay? Well, I have to ask, is the borrowing rate low enough that this net present value is positive? So basically, the firm wants to consider all its options it can do with its money it's borrowing and consider a discount rate for each, which is the alternative next best use of the money. Okay? Now, it's not just firms that make these investment decisions. People have to make these decisions too. In fact, I faced one a number of years ago when I was first teaching this course. So it was good for me to work it out in the context that I was deciding this just about the time I was delivering this lecture. And here was my choice, which is basically I had to decide on whether to invest in insulation for my 100-year-old house. Got this old house, windy, crappy, whatever. and I had to decide whether to invest in insulation. And the math was that my heating bills were costing me $2,000 a year. I was spending $2,000 a year in heat. It's a lot more now. Back then, it was $2,000 a year. Okay? The best estimate was that if I insulated my house, I could lower my heating costs by about 25%, or about minus $500 per year. About minus $500 per year. Okay? But to do that insulation would cost $4,000. So my question was, do I make a $4,000 investment to lower my heating costs by $500 a year? Well, I knew how to do that. I say I take my $4,000. That's a negative in year one. Let's say there's no effect in year one, the heating costs, because they're putting it in. So the heating savings start in year two. So then I think in year two, I'm going to save $500, but that I'm going to have to discount at some interest rate. In year three, I'm going to save another $500. I'll have to discount that some interest rate, and so on. Now, the tricky thing about this calculation is twofold. What are the two things What are the two things I still have to figure out to make this to do this calculation? Yeah.
The time frame that you're going to spend in the house and the
Yeah.
interest rate.
One is the interest rate. Now, for that one, I have to think, well, if I had money sitting around, what was the next best investment opportunity? Okay. This was the year, this is the early 2000s when the stock market didn't look like a very good investment opportunity. The next best was the interest rates were probably on the order of about 5% back then. So let's say I could have put it in the bank at 5%. But the other tricky thing is, how long will I have the house for? Okay? If I'm going to own the house forever, okay, or for long enough that it's equivalent to forever, then I know I can just rewrite this as minus 4,000 plus 500 over R. Okay? So if the interest rate was 5%, if this rate is 5%, then that's minus 4,000 plus 500 over 5%, or plus 10,000, which is well above 0. So at a 5% interest rate, if I was going to own the house forever, this is a great investment. Okay? Yeah?
You also have to consider how much it would add to the value of your house when you attempt to sell it.
Excellent point. Even if I'm not going to own the house forever, it still might be a good investment. Which is, let's say I was going to sell the house in 2 years. Then it would be minus 4,000 plus 500 over 1.05 plus 5. Well, let's say I was going to sell it after 2 years. So it's first year or second year. So you might say, well, this is clearly a bad deal. I'm spending 4,000 and all I'm saving is $500, and that's in the future where it's worth less. But then the question is, how much does it raise the value of my house? In a perfect world, given that my house will live on forever, it should raise the value of my house by $10,000. Because what I've done is I've saved $500 forever. So whoever buys it after me should be willing to pay $10,000 more for it. Okay? But the question is that information, will that percolate down? Will people actually include that in the value? So in some sense, the decision I had to make was, will I live there long enough that even if the next people don't value it, I'll still end up having the positive net present value. If I live there more than about 10 or 12 years, that would be true. Okay? And the second thing is, if I'm going to live there less than that, will the price go up enough that it will that the net present value will be positive? I decided to do it. I've been there at least 10 years since, so it was a good decision. But this is exactly how consumers face these kinds of decisions every day. Just as uncertainty affects decision-making of people every day, so does thinking about streams of payments over time. Okay? Yeah?
Did you leave out the square on the 500 over 1?
Yeah. Yes, you're right. Good point. Okay, so now another very interesting application of this that's made more relevant to you. You guys aren't thinking about insulating your houses right now, but you have recently, your family has recently thought about a very important decision, which is not about investing in physical capital, like investing in a machine, but investing in your human capital. An important theory due to Gary Becker, a Nobel Prize-winning economist at Chicago, was that just as we could think of firms building and buying machines and investing in physical capital, we think of people investing in education as like building your human capital. Okay? You're spending money to improve your long-run productivity, just like buying a machine improves the firm's long-run productivity. So it's exactly the same thing. It's just instead of investing in a building or machine, we invest in you. And likewise, human capital investment decisions are subject to the same net present value considerations that physical capital production decisions are subject to. So let's think about this with an example from the book. Okay? So imagine that if you go to college, if you don't go to college, you're going to work from age 18 to age 70. And if you do go to college, you work from age 22 to age 70. You get the extra year dinking around in Europe or whatever. No, 18, no, that's right, 18, 22, 4 years. Okay, so you basically you either work from 18 to 70 if you don't go to college, or 22 to 70 if you do go to college. Okay? Imagine, moreover, that college costs $10,000 a year. Obviously not MIT, okay? Some state school. Okay, $10,000 a year is what college is going to cost. Okay? And the cost of going to college is twofold. One is you pay the $10,000 a year. Second, you forgo earning while you're in college. The benefit of going to college, you earn a lot more once you graduate. On average, at age 22, the typical college-educated person, once again, not MIT, but typical college-educated person, earned about $30,000, while someone with a high school diploma only earned about $20,000. So you earn a lot more thereafter. So basically, the trade-off is you pay tuition up front and you lose earnings up front, but you earn a lot more starting at age 22. Well, how do we think about whether that's a good investment or not? Let's look at figure 22.1, the present value of education. What you see is a diagram of the net present value calculations. So from age 18 to 22, there's a huge cost, okay, which is your foregone earnings plus the amount that you had to pay to go. Then starting age 22, there's a net benefit, which is you earn more. Basically, whether the net present value is positive depends on comparing the shape of these and discounting the fact that the earnings you make from going to college are worth a lot less. So what's striking here is that basically, if the discount rate is more than 5.1%, it turns out not to make sense to go to college. Pretty amazing if you think about it. You earn 50% more if you go to college, 50% more. And yet, if the discount rate is more than 5.1%, which it's been typically in many eras in our society, okay, it's going to end up not making sense to go to college. Why? Because the upfront costs are worth so much more. The upfront benefits of excluding college are now, and the benefits of your education are distant. Okay? So as a result, because of net present value considerations, unless the discount rate's very low, it's not going to make sense to go to college. Okay? Now, it turns out now, of course, the discount rate's very low. But basically, we have to ask ourselves, now we ask ourselves, okay, basically, what is the discount rate your parents face when they decide whether to send you to college? Or maybe you faced it. Maybe you're paying for your own college. What's the discount rate you face? Well, once again, it's the opportunity cost of the money you used to go to college and the opportunity cost of what you could have done with the money you made if you were working now at the Gap. Okay? The opportunity cost of the money you could have made is you could have saved that at some interest rate. But the truth is, whatever you could have saved it at, nothing's yielding much more than zero right now. There's no investment that yields anything. So the interest rate's very low on that savings. Okay? Moreover, you had to borrow the $10,000 a year, in your case the $50,000 a year, to come to college, and that's at the borrowing rate, which is still above 5%. Okay, even in this economy. Yeah.
What the discount rate is?
The discount rate is the interest rate in this net present value calculation. So basically, when you're considering whether to go to college, it's the rate at which you discount those future extra earnings that you're going to get. So the discount rate is your version of the interest rate. It's the opportunity cost. Okay, the opportunity cost to you of what you could have done with that money. What you could have done with the savings from working is basically nothing, would have sat under your mattress. However, the money you had to borrow to come to college, okay, that you paid 7-8%. That is going to be, that's money that has a pretty high discount rate. You could have that's money that's worth a lot less in the future. So at the end of the day, with today's interest rates, it almost certainly makes sense to go to college. Okay? However, when interest rates are high, it might not. And that's an argument why the government may want to subsidize student loans. The government's in the business of subsidizing student loans and making student loans artificially cheap. That's a pretty big government expenditure. It's on the order of $30 billion a year. Okay? Why is the government doing that? Well, this table tells you why. If the government thinks that there's social benefits from having a more highly educated population, then essentially by intervening to lower the discount rate through subsidizing college loans, the government can encourage people to go to college. Okay? Questions about that? Okay, so that's how we think about net present value investment decisions, which is basically put everything in today's dollars and then on net ask if it's positive or negative. Now, the other thing I want to talk about in terms of government policy and in terms of important issues in this area is about increasing savings. I want to talk about increasing savings in the US. Okay? Why do we care about increasing savings in the US? I mean, why do we care about that as a goal? After all, I said savings is a bad, right? Consumption is the good. Why do we care about savings? Well, the fact is the US government does. The US government spends hundreds of billions of dollars a year encouraging individuals to save in ways I'll describe in a moment. Why do they do that? Well, the reason they do that is because savings becomes the engine for growth in our economy. Basically, as savings goes up, that increases the pool of capital available for firms to invest, to draw from. In other words, that shifts out the capital market supply curve. In terms of the diagram we had last time of the capital market, that shifts out the capital market supply curve or increases that pool of capital. Okay? As the capital market supply curve shifts out, what happens to the interest rate? It falls. That leads the real interest rate to fall because there's a bigger pool. It's cheaper to get from it. As the pool grows, it's cheaper to draw from it. Okay? That lowers the interest rate. What does a lower interest rate mean for any given investment to its net present value? It means it's higher. It means that any given investment has a higher net present value now. Because a lower interest rate means you might as well invest instead of just putting the money off to the future. And a higher net present value means more investment. So more savings becomes the engine of growth for our economy. Because savings promotes investment. When people save, it lowers the price of borrowing. Firms are more likely to borrow, and they invest more. And so that's why savings is so important. And this is basically a lot of what Bob Solow won his Nobel Prize for, a famous professor from MIT, won his Nobel Prize for, was pointing out the critical role in savings as an engine of growth. Okay? Is that basically savings becomes the key engine to growth. And as a result, society should care about how much individuals save, not just how much they consume. That's why saving is so important. The problem is we don't save a whole lot in the US. In China, for example, the savings rate, depending on how it's measured, is on the order of 30%. So for every dollar people earn in China, they save about 30 cents. In the US, it's about 3%. For every dollar we earn, we save about 3 cents. It was negative for a while. Yeah?
Are those rates including like taxes and other things that people have to pay? So is it like revenue or is it?
It's a share of your disposable income you save. The share of your after-tax, the check you take home, how much of it do you save and how much do you spend? US citizens spend about 97 cents on every dollar we take home. Chinese citizens spend about 70 cents on every dollar they take home. You might have noticed China's grown a hell of a lot faster than the US over the last 30 years. Okay? It's no coincidence. They're basically building up a stock of capital that's allowing their firms can draw on at a cheap rate and invest. And that's why something like 20% of all the world's cranes are in Shanghai right now. Okay? Because basically they have a huge pool of capital they can draw on to build all those new buildings and invest. Okay? So this is a big problem for our place in the world economy. The US is falling behind the world economy because we're not saving enough. We're not building up that pool of capital that our firms need. And as a result, there's a huge public policy effort to promote savings. Okay? And in particular, there's an enormous amount of emphasis on tax subsidies to retirement savings. Tax subsidies to retirement savings. The basic idea here is that basically, when you put money in the bank to save for your retirement, the interest you earn on that money is taxed. The interest you earn on that money is taxed. That lowers the rate of return to savings. And, assuming substitution effects dominate, that means you save less. Okay? So in today's system, since we tax the interest you earn in the bank, okay, you save less, people think. We still don't have quite convincing evidence on that, but people usually presume substitution effects dominate. Okay? There's less savings, partly because we're taxing savings. As a result, there's less investment. Yeah?
When we talk about savings here, are we like talking about just private savings, or are we also concerned with like what the government is doing?
Excellent question. What we care about, of course, and that's a great, let me actually come back to that. But let me answer that, but I want to come back to that. It's important. What we care about, of course, is the total pool of savings and the total net pool of savings. And if the government draws from that, that's less money the firms can draw from. So you're absolutely right. We care about the net level of social savings, which is people plus government. If people save a lot, but the government has a huge deficit, that cancels out. And I want to come back to that. It's very important. Okay. So basically, we have these taxes. Well, actually, this is a good point you raise, which is we take these taxes, we tax your interest. That discourages savings, but at least it raises money for the government. So on net, it's not clear if it's a bad thing or a good thing for savings. Right? On the one hand, at least we get money for the government, which can reduce the government's deficit. On the other hand, we discourage your savings, which may reduce your savings. So on net, it's not clear. But generally, the assumption is that on net, total social savings falls. Okay? But as the question points out, that assumption relies on two things. First of all, it relies on substitution effects being dominant income effects. And it relies on substitution effects being so strong that the reduced savings as we're taxing it exceeds the extra revenues we get from taxing it. Okay? But under those two assumptions, the government might want to offer some tax subsidies or try to offset this taxation of capital income by offering tax subsidies to individuals. Okay? And the way we do that is we say that you can save for your retirement tax-free. We allow you to save for your retirement, actually not tax-free, let's say it again. We allow you to save for your retirement on a tax-deferred basis. We allow you to save for your retirement on a tax-deferred basis in many ways. So for example, we have employer-provided pensions. Pensions are plans that your employer sets up. Okay? Pensions are plans that your employer sets up where you take part of your salary and that is not taxed. Instead, it's saved. And when you retire, you get that savings and then it's taxed. Okay? So in other words, right now MIT, let's say, takes $2,000 from my salary every year, puts it aside. When I report my income to the IRS, it's $2,000 lower, so I'm not paying taxes on that, even though I earned it. That money's in an MIT pension account that's building up. MIT's invested, it's building up. And when I retire, I'm going to get that money and then pay taxes on it. Okay? Now you might ask yourself, so what? Well, what the hell's the advantage of that? You pay taxes now, you pay taxes later. Who cares? Why is that a benefit to me?
Because the present value of the money in the future is less, so the after-tax amount is going to be less, assuming that taxes don't rise by a substantial amount in the future.
Exactly. Assuming tax rates stay the same, let's leave that. The point is, just as money in the future is worth less than money today, paying taxes in the future is better than paying taxes today. So if MIT takes the $2,000 aside from me and saves it, and I pay tax on it in 25 years when I retire, okay, that's 25 years with a 5% discount rate. That's nothing. Okay, 25 years 5% discount rate. That money's worth like a third. Those taxes are worth like a third of what they are if I pay them today. So basically, by deferring taxes, we are wealthier, just like by deferring payments, we're poorer. To see that, let's go to the whoops. We don't have the table here. Okay. So on the what? No. There was That's okay. Let me just sort of explain an example. Okay? Let me just do an example here to explain that. So imagine you've got an individual who's a 70-year-old. So someone about to retire. Okay? They're a 70-year-old, and he earns $100 on his job. Okay? And he's trying to decide, and he wants to save it for 1 year and then spend it. Okay? He's earning $100. He wants to save it for 1 year and then spend it. Okay? And he has two choices. He can put it in the bank, or he can have his employer hold it aside as a pension payment and he can get it next year. Okay? And let's say the interest rate is 10%, and let's say his tax rate is 25%. Okay? Now, if he puts it in the bank, 1 year later, if he puts it in the bank, so the bank route, what happens? First of all, the $100 he gets is going to get taxed. So he's going to have $75 to put in the bank. He's going to put that in the bank, and that's going to yield $750 in interest after 1 year. But that will also be taxed. That $750 interest will also be taxed. So that $750 of interest, he has to pay $1.88 in taxes on that $750 of interest. Okay? So on net, he's going to end up with $10 of interest. OK, so basically end up with $75, $82.50 minus $188. So he's going to end up with $80 and 32 cents. Is that right? 22 cents. $8.22. OK? So you end up with $80.22. Now, if instead he asks the employer to hold it aside as a pension, okay, then he gets the whole $100. And that gets saved at 10%. So he earns $10 of interest. So when at the end of the year, when he gets the pension payment from the employer, he gets $110. That is then taxed at 25%. And he ends up with $82.50. He ends up with more money. Okay, even though it's just paying taxes 1 year later, he ends up with more money. And the reason is because he got to earn the interest on the taxes instead of the government earning the interest on the taxes. Here he pays taxes up front, so he has less to save, so he ends up with less. Here, by paying taxes later, he gets to earn the interest on that extra money, and he ends up with more. So by deferring taxes, he's effectively richer. Okay? And this is a very simple example. Okay? If you did the same example, instead of making it 1 year, you made it 30 years. 1 year, instead of 1 year, you made it 30 years. Then you end up with twice as much money if you go the pension route as you go the regular savings route. Twice as much money just from deferring taxation for 30 years. Okay? You get taxed either way. It's just that you get to earn the interest instead of the government earning the interest. Okay? So you get, yeah. OK, so let's come to that. Your pension does earn. Let me make sure people understand the math here and why it's a better deal. OK, do you earn interest on a pension? It's a good question. There's 3 ways that you can have tax-subsidized retirement savings. And let me go through them clearly now. One route is the pension. The pension is that is a pension. Under a pension, your employer takes money out of your salary, saves it in some account with your name on it, but they invest it. Okay? And then you get the money when you retire. An alternative, which firms are slowly moving to, is 401k accounts, which you've all heard of by now. 401k accounts are just like pensions, except you control the investment of the money, not the firm. So under a pension account, your employer takes money out of your salary, puts it aside and invests it as he likes, and you get the return when you retire. 401k accounts the same thing, except you decide how much to take. The employers decide how much to take, and you decide how to invest it. Okay? And then you get the return at the end of the day. But the tax treatment's the same. Yeah?
Isn't it also one's defined benefits and one's defined contributions?
Well, within pensions, there's 2 kinds of pensions. Okay? There's defined benefits and defined contributions. Defined benefits, we can think of this as old style and new style. Defined benefits is what like the auto companies had and the steel companies had, and basically it's dying away. A defined benefit pension is one where you don't actually get an account from your employer. They just take money out of your salary, and then when you retire, they pay you some amount which is unrelated to what you put away. It's related to something like how long you worked at the company and what your wages were. So defined benefit pension, they literally define the pension benefit you get. Okay? And it's got no direct relation how much money they took away on your behalf. It's related instead to what you earned and how long you worked there. A defined contribution pension is what I described. It's literally an account with your name on it. And that's what most pensions are now. Almost any firm you guys will work for will have a defined contribution pension, okay, which is one where there's a little account with your name on it. Many will have, and most of you will have 401ks where you actually control the investment. Okay? And then finally, the last option is IRAs, not the Ireland thing, but individual retirement accounts. Okay? These are accounts which operate outside the employment setting, where you can literally set up your own pension, effectively, by taking money, putting it in the bank, and calling it an IRA. So the thing about IRAs are not special investment vehicles. They're just a label for savings that you do. Any kind of savings can be an IRA. You can have gold in your IRA. You can have cash in your IRA. You can have whatever you want in your IRA. Any kind of investment is an IRA. What an IRA means is you say to the government, this money, up to $5,000 a year, don't tax me on now. I'm going to put in a specially labeled bank account, and you'll tax me on it when I retire. So it's just like a pension, but you set it up on your own. Your firm's not involved. Okay? And basically, whether that's a good deal or not is going to depend whether all of these are a good deal or not. Oh, let me just say in the IRA basically, if you're not wealthy, if your income's below about $75,000 a year, it operates just like I described. If you are wealthy, if your income's above about $75,000 a year, then you can't get the tax break on the IRA. So IRAs are really more focused towards lower income populations. Now, here's an interesting question that you all face. You're going to get jobs in a couple of years, okay? And your employers are going to offer you pensions or 401ks. You can set up an IRA. And you're going to have to decide, do I want to do that or not? Now, what are the considerations? Well, one consideration is what I mentioned last time, which is that savings earlier in your career is a lot more beneficial than savings later in your career. The second advantage, of course, is that there's the tax break, which, of course, the earlier you do it, the more valuable it is than the later you do it, by the same logic. On the other hand, there's a huge disadvantage to these forms of savings, which you can't get them till you retire. Okay? If you take them out before you retire, you pay a tax penalty on them. Okay? So the trade-off with thinking about setting these up is you only want to put in money you're sure you're not going to need till you retire. So it's a good idea to set these up. It's a good idea to take advantage of these tax breaks. But in doing so, you have to remember that there's different kinds of savings. There's different needs for savings. You can't put savings for a house in these. You don't put savings in case you lose your job in these. These are for savings which you can honestly say I won't need for 30 years. And that's the trade-off, which is you should do it early and as much of as you can, but you should also recognize you don't want to leave yourself with no money in the bank to do this, because then if you lose your job, there's nothing to draw on. All right? And that's how one sort of thinks about these things. Yeah?
So if you said there was a tax penalty if you
Yeah.
these early, is that greater than the tax rate that you would normally pay on them? Because then even with that penalty...
It depends on how long you have the money in. If you have it in for like 20 plus years, even with the tax penalty, it's a good idea to do it. But if you're going to have it for 5 years, it's not worth it.
So it's bigger than the tax you...
Yes, it's 10% of the balance. You pay 10% of the balance in a tax. So basically whether that's a good thing or not depends on how long the money's been in there and what the foregone interest rate is. But for short investments, it's going to be a bad idea. If you have an IRA for 20 years and have to take it out, it's still a better deal than having not put it in there. Okay, one last point about 401ks that's very interesting, which is basically in the theory I've taught you in the last 2 lectures, what determines your savings is the interest rate. Okay? If the interest rate goes up and substitution effects dominate, you save more. If it goes down, you save less. But in fact, in the real world, savings is determined by lots of other factors that economists are just starting to think about and model. Okay, one which you've known for a long time, of course, is precaution. The bigger risk you face in your life, the more you want to save. So for a given interest rate, we found that individuals who face greater risk in their lives save more. Likewise, we found that government programs which protect you from risk cause you to save less. So this is another tricky thing with government programs. On the one hand, we like government programs like unemployment insurance or social health insurance that protect us in case we lose our job or get sick. we have to recognize the social cost of those programs is people will save less. And that's less savings equals less investment. So precaution is one reason why people save. But there's other factors which fall in the realm of behavioral economics, which I mentioned earlier in this course, which drive why people save. And this is one of the most important economics findings in the last couple decades, was studies of firms that change the structure of their 401ks in a particular way that shouldn't matter but does a lot. So for most firms, when you go to join the firm, they'll say, here's a benefits package. You can sign up. You can sign up for health insurance. You can sign up for life insurance. You can sign up for a 401k. OK? And that's the way it usually goes. And what you typically see at a typical large firm is new employees, there's about a 25% sign-up rate for 401ks. And over about the next 10 years, that grows to about 70%. So people don't join right away. They join slowly. OK? Some firms experimented with changing the contract in a very small way that should not matter in this course, which is they've instead said, welcome to our firm. You are now signed up for the 401k unless you tell us you don't want that. Now, that's the same thing, right? I can sign up, or I can tell them I don't want to be in. Those are identical things. It's just a question of the default. It's just a question of the default that I have to say affirmatively yes, or I have to say affirmatively no. What they found when they switched is the initial sign-up rate for 401ks went from 25% to 75%. Okay? Simply by this relabeling, simply by shifting the default, you got an incredible change in people's behavior. And what this says is that economics is about more than things like interest rates. It's about more than prices. Okay? In this course, economics is all about prices. I talked about it in the first lecture. Okay? But in the real world, when we bring psychology into it, economics is about more than just price. It's about important behavioral factors. And where this says that important policies that may be a much more significant policy than spending all this money on tax subsidies and raising the government deficit. These tax subsidies, by the way, add up to on the order of $200 billion a year we spend on these. So that's $200 billion a year we're increasing the deficit by to have these tax subsidies. What if instead we got rid of them all and just defaulted everyone to 401ks? We'd probably raise savings more and save the government and potentially save the government a lot of money. So basically, the point is that we have a lot of tools at our disposal besides prices, and that government policymakers have to be thinking about those. OK? So let me stop there. Thank you all for coming. Have a great Thanksgiving. And we'll come back after Thanksgiving and talk about equity and efficiency.